Hey, good morning, everybody. It's Hammer. Today is Wednesday, February 21st, 2024. I, of course, am Hammer with Originator Success here with your daily rate update. The only place on the web where you guys get to participate, be a part of it, and it's absolutely free. Where we talk all about the markets and rates and all that. Remember, you can join me live each and every day, 9:30 a.m. Eastern Time. If you're watching on the replay, do me a favor, give me a hashtag replay in the comments. If you're here live, say good morning. Either way, don't forget to smash that like button, tag an hello friend, share us in a group. If you'd like to get our written email lock advice to your inbox each and every day, we send out an email, www.ratelockadvice.com. Go check it out. It's absolutely free to subscribe. We also have our $7 text alert service. You can check that out at www.ratetextalerts.com or use this cool QR code. Also, check us out at originatorssuccess.com. Find out how we help you get loans from Google and social media. Last but not least, if you'd like a daily reminder, a little text message reminder about this show when I go live, so you've got the links at the palm of your hand, at the tips of your fingers, you can go ahead and use this cool QR code. You can use the Restream link, or you can go to hmmr.io/live-reminder. So now that we got the housekeeping out of the way, let's go ahead and say good morning to all of the live folks here this morning joining me. Always appreciate y'all. We got Mike Thibault here this morning, Mike Morano. Great to see both of you. Allison Foy, good morning. I know there's more of you here. Go ahead and say hello. Ron Siegel, good to see you, sir. Captain Hammer, I don't know about Captain, but I'll take it. Dan Crowley, hello. Good to see you, my man. Hope all is well in your world, and glad that you still check in. I remember that you've been got some other adventures going on as well. So if you're here this morning, say good morning. Brandy Brickler, good morning. Jerry Avila, good morning. Two of my favorite vetted VA friends. Great to see both of you. Denise Lopez, good morning. Hope all is well in all of your worlds. All right, let's go ahead and dive in and get to the good stuff here. Rate sheets this morning likely to be just a little bit better than yesterday. You're going to see slightly better pricing. Rates themselves not really changing. It's going to be just a little bit better. As far as reprice risk on the day, it's low. It's unlikely that we're going to see a lot of movement. We do have Fed minutes this afternoon. We have a 20-year bond auction. That really shouldn't be a big deal. The Fed minutes, what's funny is the Fed minutes are going to take a back seat for stock traders, for stock market traders, because NVIDIA is coming out with earnings. It's a really big deal today. There's a lot of hype around this, and because of all the AI stuff. But for bonds, it's still the biggest thing out there, the Fed minutes this afternoon. Now, the thing, though, I love what they said here on Bloomberg on the 5 things to start your day. Let me pull this up and we'll share this and I'll show you here. So they kind of hit the nail on the head here. It said the huge focus on NVIDIA means the Federal Reserve is in a rare position of playing second fiddle today. Again, that's really only going to apply for stocks. Bonds not really is going to as worried about NVIDIA. Policymakers are set to release the minutes of their last policy meeting, which might show how confident they are in the need for rate cuts in 2024. Bloomberg Economics' Anna Wong says that even though inflation and jobs data since the meeting have surprised strongly to the upside, we expect the minutes will suggest officials are likely to discount those prints heavily. Wednesday also sees remarks from a trio of Fed speakers. So this part here I want to talk about. This is probably our best case scenario at seeing things improve even a little bit. Now, again, I want to be clear. Our overall outlook is that rates have settled back to where they should be. And when I say should, I mean according to the economic and labor conditions as they've been reported. Now, many of us talked about how we feel like these reports, with seasonal adjustments and everything, they are highly manipulated, whether it's manipulated maliciously, manipulated for a particular reason, or whether they're just manipulated because of the adjustments. They are manipulated. Now, based on that idea, though, that there's a very strong labor market, that there is a very strong economic condition, then rates don't need to be much lower. It's just the reality. We want mortgage rates to be much lower, but they don't necessarily overall. Rates don't need to be lower. Now, we could argue that lower mortgage rates are going to heat up the housing market, which is inflationary. And that's something that the Fed doesn't want. So bottom line, while we want to see better mortgage rates, as do consumers, of course, it's not really something that the Fed wants to see. And based on that, that's why we're seeing kind of that idea and that condition. Markets are now more in line with what the Fed said. And let's remember, at their last dot plot, the Fed said they were looking for three, mind you, three rate cuts this year of about a quarter point. They were looking to end the year from 5.25 down to 4.5. And if we take a look here at Fed futures, the Fed pivot got way out of like, markets got way ahead of themselves when the idea came in that they were like, hey, the Fed is done raising rates. Now they're going to start cutting rates. And they were looking for a March rate cut. And if you remember, we were not talking at all about a March rate cut until recently. They were looking at June. And then, if you take a look here and you get back to the idea that markets were looking for a March rate cut and had basically been pricing it in December, now have come to terms with the fact that they think rates will remain unchanged. This column here is 5.25, which is where they're at now. When we look at May, there's only about look at this, it's down to a 32% belief that we'll see a rate cut. It's 30%. And basically that puts us back in line with June. And there's an 80% expectation that we'll see rates cut by June. Now, again, this is bringing us in a position where rates are settling back where they kind of should be. As much as it sucks to see rates that are back in the sevens, which we're absolutely seeing for conventional. Govies are a bit cheaper here, but conventional is back above 7. However, the reality is, at least we know that things are settling in. We should not go back to where we were in October. Things shouldn't get worse. We shouldn't be seeing the 8s. Again, what we have to do is we've got to be watching and manipulating rates and rate sheets and rates to consumers to be careful about the coming EPOs when that time comes. But this should at least minimize some of that. We were looking at the horizon that those EPOs were coming. So let's see what you guys had to say. I see some comments in here. What did you say? Ron said, conversation with the jobs market really is if we look deeper into the data. Absolutely. And Rawich is a wizard. He's a very, very bright guy. He's got the options trading platform that he's always promoting, and I think he's very good with that. So you guys should check him out. But yeah, Dan Rawich, he's right. There is weakness in that jobs market, but at the end of the day, the data that's reported is what's going to affect the rates, not the realities of what's underneath. Now, what Ron is talking about and the realities here, this is why my advice for locking or floating has changed a little bit, and why yesterday I talked about locking, and now that I'm seeing things settle in, I'm comfortable going back to a little bit more of a cautiously floating stance. Now, loans closing in the next 15 days, I would lock, because we're right within that window where we're not going to be able to make it to March 8th. We're on the 21st. So we got the 28th, the 6th. You're not going to make it to March 8th for anything closing in the next 15 days. So I would look to lock them. Now, I'm cautiously floating to start the day today because mortgage bonds are doing well today. They're up about 9 basis points. They've improved a little bit. The 10-year treasury yield, 4.26. So we're cautiously floating those, but we are still in a locking bias, right? And then for loans closing in 30 days, we've got a little bit more to work with, because we're going to see that March 8th job. We're going to see the, I forgot, when is the, let's see, CPI inflation dates. When is that CPI inflation date? I believe it's the 13th. Let me double check though. It is March 12th. So it's March 12th. So yeah, that's right. So we've got March 12th. We're going to have the CPI report. The Friday before that, on the 8th, we're going to have the labor data. So, loans that have 30 days, you at least have this opportunity. Plus, especially for loans with 60 plus days, we're going to have that March meeting, and we're going to have the press conference there. So we do have a chance to see rates improve a little bit, maybe claw back another quarter point on rate after we get into March. But between now and then, there's not likely to see too much improvement. We're just kind of floating a little bit to see if we get a nice day like today, to see if those Fed meeting minutes give us a little bit of help this afternoon. But once that's covered, we're kind of done. See some of your other comments. Robert Bashir said rates at 7, people want 6. They hit 6, they want 5. Absolutely. And Robert Scott, he hit the nail on the head. He knows exactly what he's talking about here. no matter what rates they have, people are going to want more. So you've got more to, you're always going to be fighting on there. Ron said the FOMC meeting minutes today might give us more insight into rate cuts this year. That's what, again, and that's what they're looking at, Ron. And that's what I was just talking about here with this little channel. But even that, our best case scenario is that they basically say that, they're a little less data dependent, but we're going to get more data anyway. I don't think that there's anything in these minutes that are going to cause markets to get ugly or to get overwhelmingly great. We could see a good day where right now, if we're up about 11 basis points, maybe we end the day 20, 25 basis points, we get a little bit better in pricing yesterday. Ivan agreed with Robert and said, I was giving 2 3/4 and they wanted less. Absolutely. Everyone always wants it, right? And they tell you that somebody somewhere was going to give it to them. Mike said, I've seen many people talk about the jobs number being weaker than it was. How do the Feds handle this thinking? I think that they believe some of it too. Remember, they're trying to act ahead of what's, coming down the pike. But it's not just that jobs data. I mean, look at the inflation data that we got. We got tremendous. Remember on Friday, that PPI inflation data was through the roof. It was hugely stronger than expected. The CPI inflation, consumer inflation data earlier in the week, that was more in line with expectations, not as much of a big deal. But, and then we're going to get the PCE on February 29th. That could possibly help a little bit if it comes in, at least a little bit cooler, because again, that's the Fed's favored gauge of inflation over the CPI. And it does right now show a little bit lower, but overall, this is kind of that point where we're at. Let me make this full screen. I want to show you guys the bigger chart for a minute. So looking here, and let me go ahead and pop this off. Taking a look here, y'all, we're seeing this purple line. We really want to be watching that. When it comes to technicals, we fell below this purple line, which is the 200-day moving average. The next day, we were back above it. And then we've come down and tested it here. We came down, broke it, came back up and tested it here. This 200-day moving average has been a really solid technical support level. It's currently at 98.66. That's about 20 basis points lower than where we're at now. That is our basic floor for this range. This 200-day moving average. And you can see even yesterday, we kind of touched it, came back up, ended flat. Today, we're up a little bit. Even if we lose ground, we're looking for support here. When we look over here at the 10-year, let me zoom in on this and see if we can't get this a little bit closer. All right, looking at that 10-year treasury yield here, this is support. We don't want the yield to go higher. Remember, the yield is reverse of mortgage bonds. Mortgage bonds, we want to go up, not down. The 10-year yield, we want to go down, not up. As far as what's given us support here, you can see we tested it a little wick here. There's a little wick here. There's a wick here. We've tested this 100-day moving average, this green line. That's currently at 4.33. 4.33. We're at 4.26. So this has given us a real strong technical support on that 10-year treasury yield. If we were to break above that, that would be a scary thing. We would want to be very aware of that. But as long as we're below that, it's very likely that we see the 10-year stay very much in this range. The 4.33 on the 100-day moving average. And then down here, we have a convergence of the 25 and 200-day. It's really the 200-day that we're watching, though. And that is at 4.14. 4.14. So we've got 4.14 as the lowest that we would see it improve. That would give us about 12 basis points improvement. And then if it got worse here. So watching this range, the technicals are going to tell us a lot right now. Same thing over here at mortgage bonds. We have the 25-day moving average pulling down. We have the 50-day moving average, the red line that's leveling off, and it'll start to fall down a little bit now. We're going to be watching to see this. You can see here the 50-day moving average did act as strong resistance from further improvement over here. Probably going to be the same case in the future. So it puts us in a spot. Like I said, the lock advice remains as I wrote it here. Let me put it up on the screen one more time. Cautiously floating everything, but still a locking bias for loans closing near term and those risk averse. So that's it for me, my friends. Thank you so much for joining me. Sorry yesterday's video on the plane was so choppy. And then I had the flight attendants talking there. They were really trying to get that plane loaded. People were going slow. So anyway, back in the office next week. I'll be in Dallas. Also, next month, I'll be in Atlanta. Look for an email I'm going to send out for March 13th. I've got a discount code if you're interested. I am going to be speaking in Atlanta with some other rock stars. I'll tell you more about that tomorrow. All right, my friends, I'll see you guys later. Thanks you again for joining me, and we'll talk more tomorrow. Bye-bye.